Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today is a full-time buy and hold commercial real estate investor with 15 years of experience. He currently owns multifamily, single-family office, medical office, retail, and land. Scott Price is the founder of Bonvolo Real Estate Investments. Scott, welcome to Purchase to Profits. It's great to have you on the show.
Thanks, Seth. Happy to be here.
Yeah, pleasure is all mine. Really looking forward to speaking with you. To kick things off, tell us about your real estate goals right now.
Sure. Yeah. Well, since I've been at it for 15 years, I've achieved several goals along the way. And really, I'm at the next phase of my business. So early on goals were accumulating a portfolio, accumulating passive income to the point where I could be full-time and all of our family income was coming from it. And that's been the case for a while now. And then really the next step in our business is getting into syndications, because I've worked with investors in the past on some of my deals. But for the most part, I've snowballed. In other words, I've taken funds and income from properties and rolled them up into bigger properties and rolled them and rolled them and rolled them. But it's all been on my own. And now next goals are around getting into even bigger acquisitions and working with others to do that.
Yeah. And when you were rolling your properties, were you using 1031s to do that?
In some cases. In other cases, because I'm buy and hold, it usually was not a 1031, although recently, because it's such a seller's market, I have sold a few properties. It's kind of one of those things where every once in a while I'll get an offer and I'll say, well, I wouldn't pay that, but if you're willing to pay that for my property, sure. But for the most part, what I've done is worked on value add, adding income, building up the income, rolling that back in another property. Or the other thing that I've been doing quite a bit is as the market overall has risen because of increasing income and decreasing cap rates, I've got a good bit of equity there. So I've been doing cash out refinances.
Nice.
That way I can hold on to my properties, and there's a little bit less cash flow because I have a higher loan balance, but I can more than make up for that little bit less cash flow on the first property by now buying a completely different second property that has even more cash flows, in aggregate. So been rolling them forward that way.
Yeah. And at what point did you know it was time to switch gears? Because you had been building the snowball, and then now you're switching over to syndication. So what sort of indicators were there saying, hey, listen, like it's time to kind of change things up?
Yeah, the biggest thing was I really wanted to be full-time and be able to devote the time needed to have syndications for investors. It's one thing to invest my own money; it's quite another level of responsibility to invest other people's money. So I've been full-time for about a year and a half. I could have stopped earlier than that, but as far as W-2, but I kind of kept going, and actually it was good because then that snowball effect just kept going. None of our investment income was going to pay bills or anything like that. It was all being rolled back. And my wife was able to leave her job about 5 years ago, so she's also full-time in her business as well. So as far as getting into syndications now, it's partly because I've been doing it for 15 years. I've been selecting, acquiring, managing them in a number of different asset classes, so I feel very comfortable there. And then now that I've been full time for a while, I can really devote the time and attention that it needs to do syndications.
Yeah, and in the bio I read, you've had experience in a lot of different niches in real estate. What is there one that you gravitate towards more than the others, or how did you? Because some people just focus, let's say, on industrial, and that's all they do. And it's really interesting to speak with you because you've dabbled it in a whole bunch. So, what led you to have that that mix in your portfolio?
Yeah. I generally prefer multifamily, but at the same time, like you're pointing out, I also have office, retail, medical office actually, and land. And the real reason that I've diversified is I've felt comfortable enough in those other asset classes in terms of understanding what are the key fundamentals, and they are very different than multifamily, no doubt about it. But understanding the key fundamentals that when I came across a particularly good deal, basically it gave me the opportunity to be opportunistic. And the other thing is that a number of, not all, but a number of my office and retail properties are also triple net. And for the listeners who may not know triple net, in a nutshell, it essentially means the tenant is responsible for everything. A little bit of a generalization there, but essentially they're generally responsible for maintenance, property taxes, insurance, things like that. So it's fairly hands off, and because of that, and because of long-term leases, and always looking for good tenants, I felt that I could diversify into that and not get too spread thin. In other words, once that engine gets rolling on those other asset classes besides multifamily, they can keep running for quite a while, actually, especially if you're on a long-term lease with a really good tenant. So I felt comfortable with it. And then as I've done more of them, then I, of course, just get more and more comfortable with them. So there are some other asset classes that interest me that I haven't done yet. And I actually could see dabbling in a couple more. But
Oh, well, hey, if they're there, why not? And you can't argue with the triple net lease. Those things are pretty amazing from the landlord perspective.
yeah.
Yeah. So what would you say then is your biggest challenge right now in your business?
Biggest challenge is deal flow. So, and especially since I am finding some properties on the smaller side, and I have been pursuing those on my own. In other words, not doing syndications. But when I get to the larger properties that are more oriented to bringing in other investors, it's a different environment, than it used to be 5 years, certainly 10 years ago. And that's the hardest thing, because especially if you're going to do a syndication, you have to find something that not only meets all the criteria of a good investment and has enough buffer in it to take a downturn and things like that, but there's got to be enough meat on the bone. There's got to be enough left over so that I can provide a really good return to investors and have something left over to make it worth my while to do it in the first place. And in this extremely low cap rate seller's environment right now, that's the most difficult thing. I have been addressing that, especially now that this year that I'm getting more and more into it. Last year I took some time off in a way because I built our home, so I was kind of focused on that. But now I've been working a lot with brokers and wholesalers. So I actually get, and because I'm known to perform and I have a track record and things like that, and I can close quickly, all that kind of stuff. I get some decent deals that way, at least some things. So that's what I've been building up over the past couple months, is kind of getting that engine reignited.
Yeah. And so what did you have to change then in how you thought about real estate as an asset to go from, let's say, the smaller deals to then a larger syndicated deal? Like what changes in the way you approach it and you think about it?
Yeah, well, aside from the returns, just in terms of how to distribute it and make sure that there's enough for everyone, a lot of it has to do with how I can scale it and how I can dependably implement a business plan. And so what I mean by that is I'm always going to have a business plan for any of my personally owned properties. If I have one that's for investors, then I'm going to have a much more solid written one with really good people in place, because I've got to be able to scale up that plan through others. And there's a lot of reliance on that. By through others, I mean contractors and property managers and on-site personnel and things like that. So the biggest change in mindset is really being very methodical and proactive and thinking, not only how am I going to raise rents $100 per unit by changing out some appliances this year, that kind of thing. But thinking, okay, in 2 years and in 5 years, what am I going to need to have in place now so that the steps in this overall plan are going to occur? And again, it has to do with responsibility, responsibility to other people's money. So that's really the biggest thing. Other than that, like I said, I've been doing it for 15 years, and I've been, managing and acquiring and all that kind of stuff. So I'm ready to do it, but it's another level of making sure all the T's are crossed and the I's are dotted.
Yeah. Well, and even now that you're full-time, but before when you were working, you must have had to have developed some routines and rituals because you were basically juggling two things at the same time with your job and your portfolio. So what sort of routines did you develop to help make you successful?
Yeah, I can actually answer that a couple different ways. For a period of time, for I'd say the first 5 years, it was quite busy because it was just me, and so I really did have to be efficient on my time because I was working a full-time W-2 job, plus I was growing the business. Then I would say for the second 5-year period, then my wife and I really got together we have a vision board, and we really got together about how to make that happen. And part of it was, she realized that if she came into business with me, then we could start really moving on that vision board even quicker, and it would allow her to leave her job even earlier. And like I said, then 5 years ago, she did leave her W-2 job. And in doing that, then we started really getting into processes and systematizing and delineating who's responsible for what in terms of roles. And it really helped us. Think of it more as a business. It wasn't just me whack-a-mole all over the place, at midnight on the computer, trying to deal with stuff, So that really helped. And then when we were the last 5 years, when we were on the path of me leaving, basically leaving my W-2 job and going full time, then we really started getting intentional on our longer range goals, which is the second part to the answer, which is, like I said, we have a vision board, but on top of that, what I do now and what I've done for several years is I actually have a one-page sheet of paper. It's a Word document that aligns to my vision board, but it's in like a table format, and it has every goal or all the major goals, and then it says what am I going to, and then there's a column, what am I going to do today for that goal? And I don't work on every goal every day, but that goal. And then at the end of the day, I actually grade myself. So I actually have a yes, partial, or no, which means I did it, I did part of it, I didn't do it, get on it tomorrow. And then I have some other things down at the bottom. What can I improve on tomorrow, and a couple other things. And that I have found to be really critical as far as a behavior or something I do. As I've had more free time, I've also started doing things that are kind of like in the, I guess you could say, in the Hal Elrod theme of doing things like meditation and affirmations, and things like that, and the miracle morning kind of things. And there's other things in there that I was already doing, but I've become more intentional about it. So I'd say, it's been a progressive thing, and my next step is I want to hire a virtual assistant, and so I started systematizing our processes that way as well. I'm actually looking right now as we speak. Literally, I'm working on this process right now, and putting certain things together, like how to do due diligence on a property and make it into a report that I can review. So again, it gets more and more, specific and more procedural as we grow bigger.
Yeah. Who gave you the idea for the report card?
Actually, I did. And
Really?
it was kind of like I would say it's taking the best of a whole bunch of ideas in terms of this sheet of paper that I have. It's pretty jam-packed. It's kind of a small font kind of sheet of paper, but I said I'm going to fit it on one sheet of paper, and I have a stack of them literally by my desk, and every night before I go to sleep, I fill out the one that's going to apply to the next morning, the next day. And as far as grading myself, I thought it's basically a sense of self-accountability, because if it's just a list and you move the list from day to day, it's not accomplishing as much. And so it's really a matter of really looking at myself and saying, I wanted to do that today. I thought this was a priority, and I let other lower priority whack-a-mole things get in my way. And that's okay to do every once in a while, but most people don't achieve their goals because they wander off of that. So this is a reminder: get back on it, get back on it, get back on it. And that's why I was grading myself. So just so it was right in my face that I didn't do that. You need to do that. Do it tomorrow, Scott.
I like it. I think that's a great idea, and it's obviously worked quite well for you.
Yeah, I like it. And like I said, I actually take the format and I modify it over time, and sometimes a goal will have been achieved, so I take it off, or I modify the goal. But overall, the overall format I've been going for a while, and I find it to be effective.
Yeah, no, but I like it. I might have to steal that and do my own version of that and give it a shot.
Sure, go for it.
So let's move over to a Keystone deal. So a deal that made a big impact on you and your business. Is there one that comes to mind?
Sure. Yeah, I'd say I have different deals that are important for different reasons. The one that comes to mind is one that it would actually be Keystone for two reasons. Number one, it was when I really jumped in and made the commitment to be serious. And then number two, it also had a lot of learnings with it. So essentially, this is going back to very beginning, about 15 years ago, and I did a development deal on the property that I actually lived on. And that's a story unto itself, a complicated but interesting one, but that's not the one I'm talking about here. I took the funds from that, and instead of moving up into a fancier home or using something else with the funds that I got when I sold that property, I instead actually took a step back in terms of home. I actually moved to a lesser neighborhood, much lower cost home. But I immediately invested it into a 29 unit apartment complex. And before that, I had only had one rental, and that was a single condo. And I had a bunch of learnings from that one. I actually sold it, and I know, back then, being my first one, it was this terrible experience, and real estate's terrible, and all this kind of stuff. And then I finally realized the mistakes I made, and if I still had that condo today, it would just be no problem at all. But then when I got back into real estate, I said, okay, I'm going to go feet first, and I was book smart, meaning I'd done a lot of research on multifamilies and all that kind of stuff, but I hadn't owned any. I wasn't street smart, so to speak, yet. And that deal helped me get street smart real quick, that's for sure. So, and it was Keystone for me because of that. I still own that property. That was after that development deal. That was really my first. Well, my second overall investment property, but I'd say my first one in this 15-year phase where I actually got serious about it. Yeah. And it cash flows very well now. I've cashed out, refied it, and used funds on other things. So I'm happy to have it. The reason that it was so fundamental was just learning how to deal with maintenance on older properties and what kind of issues you can come into, and frankly, in some cases, how much they cost, and dealing with contractors. And I'm glad I did it. It was trial by fire. It was it was the case of I had a lot of book knowledge, but I really got to learn a lot. And by doing that, I felt comfortable starting to get into other ones, because the other ones were actually easier. I picked quite a property to start with. It was interesting, but it was good in the end, and I'm happy to have that property still now.
Yeah. And what was it about that property that attracted you to it? Was there a value add component? Was it location?
Yeah, a little bit of both, and I had a good return on it. But part of the reason it had a good return on it was, again, things that I learned in terms of I took the seller at their word on a few things, and oh my gosh, sellers don't always reveal everything. I certainly learned that one quickly, and also they'd done a number of things. They kind of they did the classic thing where before selling, they put warm bodies in there. It's a classic, physical occupancy versus economic occupancy, which I didn't know about at the time. And then also, so had to deal with deadbeat tenants and get them out. And then even though I had a professional inspection done because of the older systems, there was a lot of issues that had to be dealt with. So it looked really good on paper. And for a little while, I had to feed it from my W-2 job because, going out of the gate, I have a pretty high bar for my properties. I'm the opposite of a slumlord. And if something needs to be fixed, I'm going to fix it and fix it right. And that got expensive. It got expensive real quick. And and I didn't do projections, initially. So, that's all the kind of stuff I certainly do now. But at the same time, it was quite the ramp up on learning, and I'm glad I had that W-2 job and had some savings because I had to float that property for a while, and it's like I said, now it's turning out a lot of monthly income, and it has a lot of it's basically doubled in value, and then on top of that, it's turning out monthly income. So
plus you've refied, so you've taken out capital just to to acquire another place too.
Exactly.
So a lot of people, first-time investors, beginners, they come up against a very challenging situation. It might be like your condo, or it might be you having to float that unit, or sorry, the building, and then they just give up. So what was it about you that actually just kept going and just dealt with all the situations and got through it?
Yeah, I did give up on it after that first one briefly. And it was because I didn't realize what I had done wrong and how to do it right. And for me, all it boiled down to with that single condo was I had a great tenant, the first one, and real estate's great. Second one, bad tenant. And it really bothered me. I mean, this person lied, and they treated me in a way that I would never want to treat anybody, and I basically took it personally, is what it amounted to. And in that particular case, my very simple learning was there are paid professionals who deal with that. They're called property managers, and that's all I needed, in that particular case, somebody to be a buffer so that, they have a thick skin, they earn their money, they're a critical part of the team. And for me, the reason I even started in real estate was I had done research going way back, even I would read books about stocks and real estate even back to around the age of 12. So I was always, somewhat entrepreneurial and things like that. And when I would research like the most wealthy people in the U.S. and all this kind of stuff, I was always interested to see that there were the household names that the Bill Gates and Mark Zuckerbergs, but there are these people you hadn't heard their name, but they made their wealth through real estate. And I kept looking into that more and more, and then I realized that this is very doable. It's not just roll the dice if your .com is popular or not, or any of that kind of stuff. This is doable. Anybody can do this. Maybe not be a billionaire, but at the same time, be comfortable. And so I started really actively looking at it. And that first, to answer your question, that first experience, I got out of it. I actually got into day trading with stocks and other things, got distracted. But real estate just kept coming back. It just made sense. It just really made sense. And then I looked into it more and addressed which in that first case, again, I just needed a property manager, but I addressed what my concerns were, and then I jumped full feet in. I both feet in. I actually got a broker's license, so I could get in, and really be enveloped in the industry, and then I started investing and all that kind of stuff. So I just needed to address whatever the items were to make it work for me, and also so I could scale too. And that was the other thing. I've set up a business model so that I can outsource as much as possible, so that I'm not the one answering the phone and swinging a hammer.
Yeah. And, as you were building and scaling, did you hit any plateaus along the way where you had to fight to break through?
The biggest plateaus, I would say, were all based on availability of funds. So because I was all using my own funds. And the nice thing is, there's some advantages to that. it's just me, which is great. So I just have to have a meeting with myself and get something done, and then also, it's 100% ownership. It's not shared ownership with somebody else. So it's some people have syndications and stuff, and they say, oh, I own 1,000 units, but they own 1% of 1,000 units, in reality, and so it's kind of a different deal. But at the same time, by relying on my own funds, it usually came down to that. And then the other one, as far as something to slow the progress down. And then the second part, especially in the last few years, is what I was referring to earlier, just in terms of deal flow. It's just getting things that meet my investment criteria gets harder and harder in today's market.
Yeah. And so what advice would you give to somebody today who's maybe an intermediate investor? Because it's so easy, you pencil out the deal, but then you get into a competitive bidding situation, and then some people forget about the numbers they worked out and just end up paying whatever to get the deal done. What sort of advice would you give to that person to help them stick with, what actually makes sense?
Yeah. I would do a couple things. One of them is, we don't know where we are in the economic cycle. We do know we're at the longest one in very long time, if not history, in U.S. history. And there usually is a cycle, and there's it's usually an up and usually a down. As to when that's going to happen, I don't have a crystal ball. But and things are pretty good right now. But at the same time, I certainly wish that I was buying in 2009, 2010. I was buying as much as I could. So I wasn't running like other people were, but I was, again, limited by my own funds. But I wish that when I was buying in the 2005 to 2008 period, that I could have bought those same properties a couple years later, and I would have been, at least from a net worth perspective, I would have been in a better position. So the reason I say that is don't reduce your criteria too much, because you may get an opportunity to meet that criteria, and you may not have to deal with a couple extra years of dealing with that property. You might actually win out. That in that case, the only potential benefit to buying now for something a little lower is if you find a cash flowing property, then then you can run with some cash flow for a little bit longer. The other piece of advice I would say, and I've always done this, is the classic one: buy for cash flow, and that will get you through the ups and the downs. It always works. If the value goes down, you don't care, as long as the rents don't go down as much, and like what happened in the last downturn. And when 2008, 2009 happened, the value of my properties went down, but I didn't care. It didn't matter, because it was still cash flowing, and I had long-term financing, which would be another recommendation for somebody right now. If they're going to get into it, make sure that I would recommend having some longer-term financing so you can ride out any downturns.
Yeah.
But I would look for, as far as somebody who's on the fence, I wouldn't reduce your criteria too much, and I would still sit there and wait for something good. It's better to have a few really good ones than a whole bunch that are just teetering on the edge and barely making any cash flow.
Yeah, no, that's definitely some good advice. So how has getting involved in real estate changed your life? You just went full-time, so obviously that's a big impact, but what are some other ways real estate investing has impacted you and your family?
Yeah, well, again, part of that, it's enabled me to do a lot of my vision board in terms of what's important. And so certainly I'm able to spend a lot more time with my daughter and my wife and the rest of my family. So that, because before with the W-2 job and all that, certainly a lot more limited there, a lot more time flexibility, which was another important thing. And we live where we want instead of where our job is. we picked a location. We live on an island north of Seattle, and it's beautiful. And I actually the best room in the entire, not the master bedroom. Most people plan around their master bedroom, which always amazes me because I just okay, you sleep there, whatever. But the best room in the house is my office, and that's the one with the great view, and that's it's got big wraparound windows and the whole deal, and so I can live where I want, and we're about to, and and the other important thing is, especially by having a good team in place, where we really enjoy travel, and we really enjoy getting out and about, and we're about to go to Colombia for a little bit, the country of Colombia, and we're comfortable with that. We got a number of properties, but we have folks in place who can handle things while we're gone, and it gives us that flexibility. And I don't have to check with any boss to ask if I can have a few weeks off to go do it.
Yeah. Actually, another guest described real estate investing as being able to run your portfolio from a pub in Ireland.
That's right.
But now we can say, in coffee fields in Colombia, same
That's
thing.
right. Exactly. Yeah. And I'm not even bringing my laptop. I've done that before, but now with there's so much power on a phone nowadays, and every once in a while I'll check in with Wi-Fi. But there's some days on this trip that we'll be out in the jungle, so we'll have no connection, and that's fine. That
sounds like a really cool trip.
Yeah, we're looking forward to it. We're going to, one place is the Lost City, and it's kind of like Colombia's version of Machu Picchu, and you got to go 30-mile hike out and back to go see it. So we're looking forward to that.
That's really cool. You'll have to take some bug spray.
Oh yeah. They have. I think they have mosquitoes the size of eagles out there.
Yeah. So let's look ahead 10 years from now. Where do you see yourself going with real estate in 10 years?
Yeah. So because we're at a point where we're full time and this is our income, it'll be a matter of being in larger deals that are syndicated, as I mentioned, and as a result having a larger team. So as we do that, then we'll be building out our support team. So if you look at the 10-year horizon, talking about larger deals, generally multifamily, even though we'll probably do some office and retail, and having employees, and because right now we like I said, we outsource everything, so it's just my wife and I, and with the virtual assistant coming soon. So it'll be different. That'll be different. But now that I'm full time, I can devote the attention to make that happen well. So.
Oh, absolutely. It's in 10 years, you'll be going from Colombia off to somewhere else in no time. That's great. So Scott, if somebody's looking to reach out, get in touch, learn more about what you're doing, where can they find you online?
Sure. Easiest place is my website, which is bonvolo.com. That's BONVOLO.com. And on there is all my contact info, actually. So however if you want to reach out directly, you can do that. Or if you just want to learn a little bit about what we're doing, you can look at the various pages on that site.
Yeah, that's great. Well, Scott, just want to say thanks so much for taking the time today and sharing that really good story about the deal and those great tips with us.
Thank you, Seth. It was fun.
Yeah, it was my pleasure. And to you, our viewers, I wish you well on your journey from purchase to profits. See you next time.